Something changed in the silver market on February 6th, and most people reading the headline missed what actually happened. Reports started circulating that Hecla Mining, the oldest silver company on the New York Stock Exchange, the largest silver producer in the United States and Canada, was allegedly declining to sell silver to Comex at listed prices, not refusing to mine, not closing down, declining to sell at the price Comex was posting. Now, before we go any further, I want to be clear about something. OG John AG here. This is financial warfare education, not hopium. That means we are going to separate what is confirmed from what is alleged, what the data shows from what the headlines claim. And then we are going to ask the only honest question. Does it even matter whether the refusal is formal, when the behavior we can actually verify tells the same story? Because here is what I can tell you right now. Samsung locked up 100% of a silver mine's output. Tesla assembled 85 million ounces of physical silver without touching Comex, and institutions are going directly to miners for supply, bypassing the exchange entirely. Formal refusal or not, something fundamental is shifting in how silver gets from the ground to the buyer, and that shift changes the math for everyone watching this market. Let's break it down. Segment 1. The claim. What actually happened on February 6th. Let me put the original claim on the table exactly as it appeared. On February 6, 2026, at 8:39 a.m. Eastern, Comex silver was priced at $74.65 per ounce. On the same day, physical silver in Shanghai was trading near $120 per ounce. That is a $45 gap on the same metal, same day. The claim that started circulating said this: mining companies, specifically Hecla and others, were allegedly declining to deliver silver to Comex at the listed price of $74.65 because they could sell the same metal in Shanghai for $120. The economic logic is simple. If someone in New York pays you $74 and someone in Shanghai pays you $120 for the same ounce of silver, why would you sell to New York? Now here's where I have to be straight with you. I cannot point you to a formal press release from Hecla Mining confirming this. I cannot show you a signed letter. The claim came from a single source, Hal Turner Radio Show, and no major mining company has publicly confirmed it on the record. So is it true? Maybe, maybe not. Maybe. But here is the more important question. Does it need to be formally true to matter? Because when I look at what Samsung did, when I look at what Tesla did, when I look at what the data shows about how silver is being routed right now, the practical reality and the alleged refusal are producing the same result for Comex. Let me show you what I mean. Segment 2. What is actually confirmed, and it's bigger than the claim Samsung C&T, one of Samsung Group's parent entities. October 2025, Samsung provided a $7 million prepayment facility to Canada's Silverstorm Mining to restart the La Parrilla silver mine in Mexico. They funded the drilling. They funded the restart. And inside that contract is one clause that made procurement managers across the industry stop reading and go back to the top of the page. Samsung gets the exclusive right to purchase 100% of the mine's silver output for the next 2 years. 100%, every single ounce, exclusively, for 2 years, locked up before it came out of the ground. Samsung did not go to Comex. Samsung did not bid higher in the spot market. Samsung went directly to a miner, paid them up front to restart operations, and captured the entire output stream before it ever reached an exchange warehouse. That is not procurement. That is vertical integration. That is a company that looked at Comex, looked at the delivery risk, looked at the $45 gap between paper and physical, and said, we are not playing that game. We are going upstream. Then there is Tesla. In mid-January 2026, reports surfaced that Tesla had assembled approximately 85 million ounces of physical silver through a combination of mine contracts, vault purchases, and private deals, without touching a public exchange. 85 million ounces, more than the entire registered Comex inventory at the time. Done privately, done directly, no Comex. And then there is what investing.com published this week. Not a silver bug on a podcast, a mainstream financial platform. Their exact words: we know of institutions that are going direct to the miners, and perhaps this becomes the norm. Perhaps this becomes the norm. That sentence deserves to sit for a moment. Segment 3. Why this is happening. The price gap that makes it rational to understand why Samsung, Tesla, and others are routing around Comex. You have to understand the gap, because the gap is not small, and it is not new. On February 6th, the day the Hecla claim circulated, Comex silver was $74.65. Shanghai was near $120, a $45 premium for physical metal versus paper metal. Today, February 27th, the gap has narrowed but not closed. Comex silver is around 87 to 88. Shanghai physical is maintaining a premium of approximately 26 over Western spot. Physical silver in Asia is at 113 to 114, while New York prints 87, two prices, one metal, same planet. Now a viewer is going to ask, Why doesn't someone just buy cheap in New York and sell expensive in Shanghai? Close the gap? Great question. And this is the piece that most coverage completely misses. China implemented a new silver export licensing system on January 1st, 2026. Physical silver cannot freely move from Shanghai to New York or anywhere else. The export restrictions, the VAT complications, the capital control frictions, they make clean arbitrage structurally impossible. The gap is locked in by policy. It cannot self-correct through normal market mechanics. So you have a $26 gap today. You had a $45 gap 3 weeks ago. And the gap cannot be closed by the normal price discovery mechanism that futures markets were built on. Now put yourself in a miner's position. You produce silver in Mexico or the United States. Comex will pay you 87. Samsung will pay you closer to the physical market rate because Samsung needs actual metal, not a paper contract that might cash settle. Who do you sell to? That is not a conspiracy. That is arithmetic. Segment 4. The system that made this inevitable. Here is the structural layer underneath all of this. And it is important because it explains why this was always going to happen eventually. The only question was when. For decades, the global silver pricing system operated on one core assumption. Almost nobody would ever ask for physical delivery. Think about what that meant in practice. At one point, the ratio of paper silver to physical silver reached 356:1. For every 1 ounce of physical silver available in the vault, 356 ounces of paper silver were promised. The system did not collapse because the assumption held. Most participants wanted price exposure, not the metal. They were happy to cash settle and roll forward. The physical delivery mechanism was a formality that almost nobody used. In early 2026, that assumption failed. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were withdrawn for physical delivery from Comex. That is 26% of registered inventory, gone in a single week. For context, that is not a normal month's worth of delivery. That is years of normal delivery compressed into 7 days. February delivery rate came in at approximately 98% of open interest. Historical normal is 5 to 15%. The people buying silver futures right now are not speculating on price. They want the metal. And when you shift from a market where nobody wants delivery to a market where almost everyone wants delivery, the entire pricing infrastructure, which was built around the assumption of no delivery, starts to strain at every joint. The miner bypass is not a cause. It is a symptom. Miners are going around Comex because sophisticated buyers are offering better prices. Sophisticated buyers are offering better prices because they understand that Comex's paper price and the physical market's real price are running on 2 different tracks, and they want to be on the right track before the 2 systems have to reconcile. Segment 5, what the coin shop tells you that Comex doesn't. Now here is the ground level picture, because the macro data only tells half the story. The other half is what is happening in the real world, at the dealer level, right now. Coin shop dealers across the country are reporting something that sounds contradictory on its face. Back rooms are full of silver. Refiners are refusing certain categories of metal or delaying pricing by 3 to 4 weeks. And yet specific silver products, American Silver Eagles, Mercury Dimes, pre-1964 90% coins, are flying out of cases the moment they are priced. How can a shop be simultaneously overloaded with silver and running out of the silver people actually want? The answer is exactly what explains the mining bypass. Not all silver is the same silver. A pile of sterling silverware in a coin shop back room is not the same as 1,000-ounce Comex deliverable bars of 99.9% pure silver. A world silver coin is not the same as an industrial-grade bar that a solar manufacturer or an AI data center operator can use tomorrow morning. The metal exists. It is in the wrong form, the wrong place, the wrong purity for the buyers who need it most. Refiners are currently telling dealers, send us your 999 pure bullion bars and rounds. We will handle those. But sterling silverware, flatware, old jewelry, odd alloys, bulk 90% junk silver, we will put it in the pool and email you when we are ready to lock a price. Translation: we do not want it right now and we are not in a hurry. That refiner behavior at the micro level is the exact same signal as the miner bypass at the macro level. The system is becoming selective about what silver it processes and when, and the selectivity is accelerating as price volatility makes the timing risk impossible to hedge cleanly. Segment 6. 2 scenarios. What happens if the bypass expands? Let me give you both sides, because honest analysis requires it, and because the 2 scenarios have very different implications. Scenario 1. The bypass stays institutional and Comex adapts. Samsung, Tesla, and a handful of other large industrial players continue routing around Comex through direct miner deals. But most of the market, retail investors, hedge funds, mid-size institutions, continues using Comex for price exposure. The exchange manages March delivery through exchange for physical arrangements, cash premiums to long holders, and margin adjustments. Registered silver stays above 70 to 80 million ounces. The paper price mechanism holds for now. Under this scenario, Comex does not collapse this month, but its relevance erodes. Shanghai gradually becomes the real physical benchmark. The paper price on Comex becomes a derivative overlay on top of a physical market it no longer fully controls. The gap between paper and physical prices does not disappear. It becomes a permanent feature of a fractured market. What does that mean long-term? Investing.com described it directly. Quote, "The official price becomes increasingly irrelevant to the actual price paid by industrial users. Comex survives but loses its role as the authoritative price setter for the metal that runs the physical world." Scenario 2. The bypass expands and delivery stress compounds. The Samsung and Tesla template becomes widely copied. More industrial users negotiate direct miner contracts. Miners, rationally preferring higher-paying direct buyers, allocate less and less output to the Comex delivery pipeline. Registered silver drains not just from delivery withdrawals, but from an upstream supply cutoff. The vault empties from both ends simultaneously. March delivery, which started today on First Notice Day, reveals that the managed roll cannot absorb standing demand. Registered silver drops below 60 million ounces before month end. The exchange deploys emergency measures. History has a name for what comes next. Silver Rule 7, liquidation-only mode. Exactly what the exchange did in 1980 when the Hunt brothers pushed delivery demand past what the system could handle. And the historical parallel worth understanding, the London gold pool. A coordinated system of central banks suppressed gold's paper price through the 1960s by selling physical metal into the market whenever price threatened to break higher. When physical demand finally exceeded what the pool could supply, it did not gradually adjust. It collapsed overnight in 1968. Gold then quadrupled over the following decade. I am not saying that is what happens to silver this month. I am saying that is the historical precedent for what happens when a paper pricing system loses its physical supply backing, and it is worth reading carefully right now. Segment 7. The supply side cannot rescue this one more piece of the picture before we get to what you should actually watch. Even if every miner tomorrow decided to fully cooperate with Comex delivery, the supply side cannot close the gap fast enough to matter in March. 75 to 80% of silver is produced as a byproduct of copper, zinc, and lead mining. You cannot decide to produce more silver. You produce more copper and happen to extract more silver alongside it. Mine supply is not responsive to silver's price signal. There is no switch to flip. The timeline for a new primary silver mine, discovery, feasibility, environmental permitting, financing, construction, first production, is 7 to 10 years minimum. The high prices of 2026 will not translate into new mine supply until 2033 at the earliest. Until then, the supply curve is locked. Recycling is rising, projected to exceed 200 million ounces in 2026 for the first time since 2012. Record recycling. And the market is still running a 67 million ounce annual deficit. Recycling at all-time highs is not closing the gap, it is slowing the drain. So when a miner bypasses Comex and sells directly to Samsung, the total amount of silver coming out of the ground does not change. What changes is who gets first access to that fixed supply. And increasingly, who gets first access is not the Comex delivery pool. The bypass does not shrink the pie. It just changes who gets to eat first. And the people eating first right now are Samsung, Tesla, and whoever else has figured out that the paper price and the physical reality are running on different tracks, and has positioned on the physical side before the two tracks have to merge. Segment 8, what to actually watch. All free, all public. I sell nothing. No memberships, no signal groups, no Discord. If you see my name on a paid service, it is a scam. You find me here and on X. Here is what to watch for this specific story. Everything on this list is public and free. Miner earnings calls and press releases. First Majestic Silver, Pan American Silver, Hecla Mining, Coeur Mining. These are the largest primary silver producers. Watch their Q1 2026 guidance language for any commentary on offtake agreements, direct sales, or changes to their Comex delivery obligations. If miners are routing supply away from Comex, it shows up in revenue disclosure and offtake agreement filings before anywhere else. Comex, registered silver. Updated daily on the CME Group website. Watch whether the drain continues through March even during a major delivery month. Continued decline with no new inflows into registered inventory would confirm the upstream supply pipeline is weakening, consistent with the bypass story. New direct miner deal announcements. Samsung's deal with Silver Storm Mining was the first public template. Watch for additional announcements. Tech companies, EV manufacturers, industrial users locking up miner output through prepayment or exclusive offtake. Each announcement confirms the bypass not as conspiracy, but as rational economic behavior spreading through the market. The Shanghai premium. If it narrows towards zero, physical supply is improving. If it widens past $30, physical demand in Asia is outpacing any managed resolution in the West. That is your signal that the two price tracks are diverging further, not converging. EFP premiums. Exchange for physical arrangements are how Comex shifts delivery demand from New York to London when New York does not have the metal. When EFP premiums spike, it means managed roll is happening at increasing cost. Watch for EFP data from the LBMA. Outro. Read the structure, not just the headline. So here's the bottom line. Is Hecla Mining formally on record refusing Comex delivery? Not confirmed by a named company statement. I cannot tell you it is confirmed when it is not. That would not be honest. That is not what this channel does. What is confirmed, Samsung locked 100% of a mine's output through a direct deal that bypassed Comex entirely. Tesla assembled 85 million ounces privately without touching a public exchange. Institutions are going direct to miners, confirmed this week by investing.com. And the economic logic behind formal refusal, a $26 to $45 gap between paper price and physical reality, is mathematically obvious and documented. Whether miners are formally refusing Comex or simply preferring higher-paying direct buyers, the result for the Comex delivery pool is the same. Less metal flowing in, more metal captured upstream before it ever reaches the vault. Comex registered silver went from 167 million ounces in October to approximately 85 to 88 million ounces today, a 47% drain in 4 months. Some of that is delivery withdrawals. Some may be upstream supply being captured before it ever registers. The net result is identical either way. The London gold pool did not announce its failure in advance. It collapsed because physical demand exceeded paper supply. The participants who understood that dynamic were positioned before the announcement, not after. This is financial warfare education, not advice. Your edge is not guessing tomorrow's price. Your edge is understanding how the pipeline actually works, where the metal is going, who is getting it first, and whether the price on your screen reflects the price serious buyers are actually paying. If you watch this far with your brain turned on, drop OG John AG in the comments and tell me, when Samsung locks up 100% of a mine and Tesla goes private for 85 million ounces, is that a signal or is that noise? OG out.